Macro investing is about spotting the contradictions between markets before they are resolved. What is the biggest logical inconsistency in global markets right now? 2025 has persuaded Wall Street to believe that Trump always gets what Trump wants. Will this consensus be proved right or wrong in 2026? Barely a month into the year, global markets have seen some pretty extreme moves. The violent swings in gold, oil, and dollar-yen over the past 2 weeks have been nothing short of spectacular. Rising volatility, however, is masking some important market trends. One of them is the stellar performance of high-beta growth proxies. These include small-cap stocks, high-yield corporate bonds, emerging market equities, industrial metals, and commodity currencies, not to mention semiconductor stocks. All of these markets have posted hefty gains year to date. What these assets have in common is that their returns are highly correlated with the global business cycle. They typically perform best during cyclical upswings, most notably at the start of a new expansion. We can debate where we are in the global business cycle right now, but today's exceptionally low unemployment rate points to a late cycle economy. So why are investors piling into assets that normally thrive early in the cycle? Can this come back to bite them in the behind? The latest global manufacturing purchasing power index provides some support to the prevailing growth optimism on Wall Street. Following 2 consecutive months of decline, the index rebounded to 50.9 in January, near the highest level in 3 years. More importantly, the increase in momentum was broad-based. With the exception of Brazil and Turkey, an upswing was recorded among all G20 economies. Germany, Canada, and Japan saw the biggest increase. Could this be a signal that the worst of the tariff impact is behind us? It's too early to say, but with the global economy proving more resilient in 2025 than most economists, including myself, expected, it is understandable that the market wants to give the data the benefit of doubt. If even the Eurozone, the perennial underperformer, managed to grow 1.4% in 2025, beating the prevailing forecast even before Trump's Liberation Day, maybe tariffs don't matter. I don't pretend to know the answer, but I do know that Wall Street spent most of 2025 preparing for the aftershocks of Trump's trade war that never came. I suspect that fatigue is why investors are now piling into early cycle winners like emerging market equities, industrial metals, and the Australian dollar. Economists have been revising up their 2026 global GDP growth forecast since last October. The largest upward revision has been for the United States. In January alone, Wall Street consensus forecast for U.S. GDP growth this year was revised up to 2.4% from just 2%. The fact that Trump's tariffs have had limited impact on inflation and consumer spending has persuaded some that the drag from tariffs is transitory. Meanwhile, it could be argued that the improvement of the U.S. trade deficit since the introduction of the tariffs reflects an increase in competitiveness. The massive jump in the January ISM manufacturing survey supports that view. The upward revision is likely also influenced by the coming midterm elections. I started arguing 2 months ago why Trump will throw the kitchen sink at the economy to ensure that his party goes into the midterm in a fighting position. 2 months later, my view has become the consensus. Many on Wall Street are now expecting more stimulus to come before November. This is why small-cap stocks and high-yield credit have done so well. The only question is whether the expected stimulus will pan out. A core aspect of macro investing is identifying pricing inconsistencies across markets. To my eyes, the most glaring inconsistency in global markets right now is this. Equities, corporate bonds, and commodities are pricing solid growth, while the rates market is still expecting 2 interest rate cuts by the Federal Reserve this year. I don't mean to suggest that it is impossible to get both strong growth and Fed cuts. It is just that I don't think it is very likely. Trump's nomination of Kevin Warsh as the next chairman of the Federal Reserve reinforces my view. We all know that Warsh is Trump's second choice. I believe Trump picked him over Kevin Hassett only because Trump is worried that Jerome Powell may decide to stay on the Board of Governors after his chairmanship expires. Powell's term on the board does not end until 2028. Trump might have thought that a Warsh appointment might bring about Powell's departure more quickly. But that is not a guarantee. Powell knows that not only Trump will replace him with a super dove, but that his departure will give the Trump appointees a majority on the board. I think the market is underestimating the hurdle for Powell to leave the Fed. I don't think Powell wants to be remembered as the Fed chair who turns the keys of the Fed over to Donald Trump. Warsh is no dove, and I don't see him doing Trump's bidding. If Powell ends up staying on at the Fed, the FOMC will likely tilt more hawkish on balance. This is the first reason why I don't see 2 rate cuts this year if the market is right about an acceleration in US GDP growth. There's only one scenario that could prove the market right. Even a hawkish Fed could cut rates into a strong economy if inflation were to slow sharply. So how likely is a meaningful decline in inflation in a strong economy? Many on Wall Street believe that AI will deliver strong productivity growth and drive down inflation. I don't doubt that this will be the case, but I'm skeptical that we will see this in 2026. While AI has given a boost to productivity growth within the tech industry, evidence of this for the broader economy has been scant. Indeed, the Census Bureau reported a decline in AI adoption by large companies in Q3, with usage dropping from 14% in June to just 12% by September. In my view, there's only one way we might see a deceleration in inflation while the economy accelerates. Shelter is 40% of core CPI and 16% of core PCE. Continued sharp fall of housing-related inflation in 2025 was the main reason why Trump's tariffs did not have a bigger impact on core inflation. Will housing inflation keep falling in 2026? It's possible. Zillow's rental data point to rental inflation slowing significantly around Q4 and into 2026. Trump's deportation drive has undoubtedly been weighing on rental inflation. According to the Trump administration, in 2025, over 2.5 million illegal aliens left the United States, including more than 622 formal deportations and roughly 1.9 million who self-deported or left voluntarily. In Q4, rental vacancy rose to 7.15%, the highest rate since 2017. But the pace of deportation is going to slow in 2026. Trump announced this week that he's withdrawing 700 ICE agents from Minnesota. A softer approach on immigration could lead to a stabilization of rental inflation. But even if housing inflation were to ease further, I think it will be offset by a pickup in the pass-through of tariff into inflation. Core PPI of finished goods rose to 3.4% in January, the highest level since September 2023. Don't get me wrong. It's not that I don't think that inflation could surprise to the downside in 2026. It is just that I don't think it's likely if the economy does as well as the market currently thinks that it will. So where does all this leave me? I think either rates are too low or the market is too optimistic about the US growth outlook. This means either rates will move higher or that stocks and commodities will go lower. Which would it be? In the short term, a lot is riding on whether the retail buy-on-dip investors will keep the wobbling stock market from entering a correction. If the 600 level of QQQ holds, then I think we will soon see a repricing of the US yield curve higher. The market most vulnerable to either higher rates or lower stocks is, of course, Bitcoin. The only question is whether Trump will throw it another lifeline. But that's for another video. Thank you for listening.